The other side of that is, from more of a policy perspective, we think that it's really important that the Fed make its decisions regarding this trade war as data-driven as they can be. So, because Joe just mentioned there's been a lot of volatility, you can see that on our graph on slide 18, just because the markets have reacted significantly to this trade war, it's important that the Fed kind of try to ignore that, focus more on key economic indicators, particularly in inflation and employment, and kind of use those to direct its policy. Well, generally speaking, we actually recently learned in my econ class that any sort of cutting of taxes obviously puts consumers a lot more money and they're able to spend more. The interesting thing that we find is not necessarily that the Trump administration is cutting taxes and increasing its spending. It's more when they're doing it. So we found that this is coming very late in the economic cycle. Like we mentioned, this is 105 months of consecutive GDP growth. So the risk of that becomes, if you're going with such an expansionary fiscal policy already so late in the business cycle, it's possible that that could come with kind of negative effects. Can I touch really quick? That also speaks to the ammo theory, which is the notion that even if the economy, you're not trying to raise rates to actually contract the economy to slow it down, the Fed right now needs to prepare. So like you said, if we're so late in the business cycle and we're reaching a point where it's coming to a close and potentially there's going to be a contraction or some sort of recession in the coming months and years, it's important that the Fed have rates high enough that it's able to lower rates to kind of recover from that. And because rates were so close to zero following the recession for such a long time, it's important that they start to raise rates just to prepare for that. I mean, obviously you don't want to go to any extreme. You don't want to say that the Fed should completely ignore markets. With that said, it is kind of part of the general Fed kind of tradition to do its best to keep its eye more on general macroeconomic indicators, whether that's things like CPI or expenditures or unemployment, as opposed to things like the equity markets. And like you said, equity markets are a fantastic indicator for consumer and business sentiment. The problem is sometimes that sentiment's so reactionary. It goes back to John Maynard Keynes' famous phrase, animal spirits, and that people just react to things to such an extreme degree sometimes that you don't want the Fed reacting, as quickly to that. You kind of want to look at things from a step back. And that goes back again to what we said about being data-driven over and over again. Is that if you look at that top graph on slide 30, I mean, every time that the U3 rate has dipped below that NIRU, we've seen a recession pretty soon after. And obviously that's going to be more suggesting that there's an imminent recession coming, but it gives some validity to the notion of the NIRU just because it's a pretty consistent pattern. Just really quickly to add on to that, obviously the Fed is not supposed to watch markets specifically and kind of base its monetary policy based on that, but it's important to know why things in the market have changed. So if you looked at our volatility slide, I think it was slide 17 or 18, you'll see that it spiked in late January and early February, and we kind of talked about why. It was things like a late in the business cycle fiscal policy, expansion of fiscal policy, and also just rising inflation expectations. A lot of that has kind of curbed since then, and the new trend you'll see in the market is a lot of people worried about a trade war and what effect that could have on the market. So it's important that the Fed understand that a lot of these changes are very short term, and it has to kind of watch its monetary policy in that context. And the other side of that is that the Fed, obviously, as Joe said, doesn't have direct control of a policy like that. So we think that a lot of the decisions that are made in the coming year about monetary policy should be more data driven. So if the Fed looks at the economy 6 months from now and says this expansionary fiscal policy really kind of overshadowed the protectionism and the economy is growing too quickly, that would indicate that